Doing good. Today we are meeting to discuss few more transactions from our second example on how to make entries in the accounting equation. So we have completed transaction number 1, 2, 3, 4, 5, 6 and 7 in the previous videos. So moving on to transaction number 8. 25th January 2017 paid rupees 3000 for telephone services and rupees 2000 for electricity and in cash. Here the beauty parlor incurs expenses on telephone services and electricity. This will result in a decrease of assets due to an outflow of assets held by the business, which is in terms of cash or bank as this is being paid. Also will result in a decrease in equity since expenses to the business will result in a decrease of equity, which we have learned in a previous session. This transaction will be recorded in the accounting equation in two different entries. First, this will result in a decrease of assets by rupees 3000 in terms of cash or bank, which will equal to nil value in liabilities as there is no obligation created, thus will not result in a probable outflow of future economic benefits, plus decrease in equity by rupees 3000 in terms of telephone expenses. Second part of this transaction will be recorded as a decrease of assets by rupees 2000 in terms of cash or bank, which equals nil value in liabilities, again since there is no obligation or there is no probable outflow of future economic benefits, plus decrease in equity by rupees 2000 in terms of electricity expenses. Transaction number 9. 29th January 2017, 2.5% interest payable for the loan obtained for the month of January 2017. Here, interest is payable on the loan obtained by the beauty parlor should be accounted as a payable since the interest is not yet paid for the month of January 2017. This will result in an increase of liabilities for the business as this will create an obligation due to a past event and will result in a probable future economic benefits outflow to the business when this will be settled. Also, interest is an expense to the business which will result in a decrease of equity as expenses will decrease the value of equity. This will be recorded as equals increase of liabilities for rupees 5000. This is arrived by multiplying 200,000 by 2.5%. This will be in terms of interest payable plus decrease of equity by rupees 5,000 in terms of interest expenses. Transaction number 10. 30th January 2017, salary payable for the month of January 2017 for rupees 10,000, while only 8,000 being paid. Here the business has an expense of rupees 10,000 in terms of salary which it has to incur for the month of January. But in this transaction the business paid only 8,000 and a balance of rupees 2,000 has not yet been paid to the staff. So this will be remaining as a payable, which is a liability, since this has created an obligation which will result in an probable outflow of future economic benefits when being paid. Also will decrease equity for the business as a result of the expense which the business has to incur in terms of salaries. This transaction will be recorded as a decrease of assets by rupees 8,000 in terms of cash or bank, as this is the amount which is paid and is an outflow of assets, equals increase of liabilities for rupees 2,000 in terms of salary payable, as this is an obligation which is created, plus decrease of equity by rupees 10,000 in terms of salary expenses, since this is the amount the business is supposed to pay in reality. So we will discuss the remaining transaction in the upcoming videos in the sequence. If you have any questions with regards to today's session, please comment your question below. Also, do like and share our video to learn and let others learn. Also, subscribe to ALFlix to enrich your knowledge in accounting and business studies. See you next time. Thank you.